Well, welcome everyone to our panel. We're going to be talking about modern money and the future of how we're going to be spending and saving money. I want to introduce our great panelists here today. First, myself. My name is Lena Rao. I'm a senior writer for Fortune magazine. Let's start with Greg Baxter, Global Head of Digital Strategy at Citi. Mike Cagney, co-founder and CEO of marketplace lender Social Finance, SoFi. Rebecca Lynn, co-founder and general partner of Canvas Venture Fund, who's also led investments in Lending Club, Convo, Relate IQ, and Practice Fusion. Adam Nash, president and CEO of online financial manager Wealthfront. And Don Kwan, senior advisor to the director of the U.S. Consumer Financial Protection Bureau. So I'd love to start this panel talking about what modern money was when I was growing up, which was like online banking. And obviously we've really progressed since that time. I'm curious for all of you, with the millennial generation really rising right now, how do you see that impacting the way that we are going to be doing things like saving money, spending money? Who wants to jump in first?
Well,
I'm looking at you, Greg.
Yeah, I'll make a start, but I'll probably make an irreverent start with this. Maybe we should put the Khyber on the millennial as a sort of a generational definition. If there's any venture funds out there, I'm thinking of creating a company, Je suis millennial, where we could all be millennials and have bumper stickers and shirts, etc. And rather than actually using this age definition, starting to think about the behavioural aspects of what a millennial is. And I think if we think of them as a leading indicator, and some of them demand greater product experiences and they demand greater purposes in the companies, and I think that that's a useful way of thinking about it. And for us, where we look at aspects of the adoption, we're looking at how we drive a different user experience. But I still think there's a lot to be played for in the whole millennial space. There are those that are looking for product-specific solutions, and there are those that are looking for solutions that are integrated into their lives. And I think we're going to have to solve both of those. The one thing that I do think is consistent is that they want to be more informed and more in control. And as a result of that, I think we're going to see more and more of a bias towards the best, and the best will be the products that they like or that connect with them or that serve them more effectively or to have better rates. But I think it's this in control and informed that is the biggest change that we've seen.
Yeah, I think I was on a panel recently at Goldman on mortgage innovation, and one of the big topics there was why aren't we getting millennial borrowers? And I talked about my experience in building a mortgage application at SoFi and going online and testing out what everyone produces and how they deliver mortgage experience. And the basic experience is you go online with your phone or your web browser, what have you. You enter a lot of information, and each step someone promises you one more step, one more piece of information, I'm going to get you a rate. And then what happens is the process stops abruptly and someone starts calling you on the phone. And if you think about how orthogonal that is to the experience, I went online to begin with because I wanted online delivery, and now I'm getting this very different experience of someone calling me, generally at dinner time, incessantly. And it's typical of how financial services looks at millennials. There's this great op-ed piece in the American Banker a couple weeks back where someone said millennials are horrible customers, wait till they're 45, they need a mortgage and they have money, and then get them. And it's this false premise that when you're 45, you want to go to branches with inconvenient hours and bad service and crappy product, and that's not what's going to happen. No offense to the banks. So I think that in general, there's this demographic, and you can make it wider than millennials, call it 25 to 40-year-olds, 60 million individuals out there that just aren't getting serviced through the banks. And I can give you multiple product examples and illustrations of why that's the case. And it creates a huge opportunity for non-bank providers like ourselves and some of the other folks here at the panel to go in and deliver a different experience.
Yeah, I think in terms of not just millennials, but just broadly, we live in a really different world. I mean, just being able to pay your bills online not that long ago was really innovative. So I've also, in Lending Club, I was an investor there, a very early investor. Also with Check, which was is a mobile wallet company that sold into it, and then Future Advisor, which is sort of next generation of investing. And I think one thing that that just would blow a millennial's mind, or even most people who are online today, is just how slowly money moves in the old world. And that there is, and Czech had this issue where if they wanted to move funds, there's this 24-hour delay, which just no one would possibly understand these days, right? People just expect things to be real time. They expect them to be instant. If they get hit with a fee from a bank, it's like, why didn't you tell me, right? Why, you can text me, right? Why didn't you do that? And so the whole way that banks assign fees and process payments and do all that is so out of date in terms of how people think about how things should work, that I think there's some real catch up to do there. But there's a lot of opportunity for innovation at the same time.
Yeah, I have to disagree a bit. I do think there's something important at the macro level going on right now that's fairly unique. This may be the first time in 40 years that we have not one, but two very large generations that are still economically relevant, right? You've got 70+ million baby boomers who control 15 trillion in liquid net worth in the US alone. And they're hitting a very stressful economic time because being +10, -10 of retirement is a very big deal. And frankly, that generation is facing retirement challenges that are different than previous generations. And that's not a problem for the next 3 years or 5 years. That's going to be the story for the next few decades. Meanwhile, we have this new generation. I would actually agree that the problem with the millennial term is that I've noticed in our client base, 60% of our clients are under 35. It seems that everyone who uses the term millennial is usually not a millennial. But that aside, you've got 90 million Americans whose liquid net worth is somewhere between 1 and 2 trillion, but are just hitting the knee of the curve in terms of that nonlinear income growth and wealth creation that happens to people in their 20s and 30s. And so, the way we look at the world right now is that, this has happened before. If you trace huge businesses like Schwab, Vanguard, even Fidelity, these were not names. But in the 70s, when the baby boomers hit their 20s and 30s, there was an opportunity to build new services, new brands, new ways of doing things. It didn't eliminate the old brands or old services, but we now have several multi-billion-dollar giants that were born out of that era. And that hasn't existed until now, that same opportunity. So we spend a lot of our time really thinking about the different needs, not just of 20-somethings and 30-somethings in general, but how this generation is going to be different than the ones that came before.
Do you feel that some of these services that cater to a generation of people that want automation, they don't want to wait in line, they don't want to go through all those sort of hoops to get a mortgage, is there a future where banks like Citi or Bank of America or more established incumbents are going to be absorbing these companies, or do you think that you're just going to have all these different options out there?
I think established financial services companies such as Citi or Bank of America, they are already, directly or indirectly involving in either directly investing in those companies that serve the needs of millennials or younger generation. But also they can directly involve themselves by acquiring these companies. And the example one case Greg and I just talked about before this panel was last year, BBVA paid $117 million to acquire Simple, which used to be called Bank Simple, which is basically a startup that provides a very sleek mobile checking account, bank account to tech-savvy young consumers. So I think we'll see a lot of similar things happening down the road, and I think banks are realizing that young generation, they probably don't understand what checks are. They don't want to, and I just want to follow up on what Greg said, which I think is very much in agreement with him. Millennials, they want to be in control, and especially we see after the financial crisis, the young generation, they do not want to use credit cards. They favor debit cards or prepaid cards. And this is going to pose a significant challenge to financial service providers because these young consumers, as they mature, as they get married, they want to get car loans, they want to get mortgages. How are banks going to underwrite them? So this is going to be a huge challenge down the road. Do
you have any perspective on that?
Well, I think that there's opportunity and threat as you look forward. And I think as an industrialist, if I use that term for the big incumbents, we need to figure out how do we innovate. But and that's difficult, and we've got legacy issues, etc. But we also come to the party with a phenomenal customer base, with phenomenal assets, and with pretty much amortized back-end systems that handle a certain volume, etc. So there are certain assets that come with the cost of being an industrial player, and the innovators on the other side need to industrialize. And I think that as we start to see, there's opportunities to acquire. There's also phenomenal opportunities for partnership. There are just customers and balance sheet aspects that we simply cannot access. We simply could not bank. Where there are partners that are targeting exactly that sector. Now, are we in competition with them? Sometimes, but they're also a phenomenal opportunity to expand financial inclusion, etc., and to address some areas that we simply can't. But if you look at the opportunities not only to acquire those companies, but the opportunities to consolidate within financial services. In the US, there's 7,000 financial institutions in the US alone. There won't be, in 5 to 10 years. So I think there is going to be consolidation, there's going to be more partnerships, etc., and significant opportunities for us. The key thing for me is that I still think the future of the innovators and the future of the incumbents are in our own hands. I don't think that the game's left.
Well, I'm curious, and also Rebecca too, since you invest in these companies, what do the entrepreneurs on the panel think of these partnerships with bigger industrialists?
I think it's very difficult right now. From my point of view, the money business is a trust business. The customer relationship is not just a normal consumer relationship. I come from companies like Apple and eBay and LinkedIn, and when you're dealing with money, there's a more significant amount of responsibility, a more significant amount of trust that the customer and the client is putting in you. I don't think it'll surprise anyone in this room to say that right now actually happens to be one of the rare times in history where the existing brands in financial services are incredibly damaged, particularly with young people. It's partially to do with the financial crisis, there's no question. But it also has to do with the revenue models and the experience that young people have had, right? This industry as a whole has tended to charge fees and make too much money off people who can't afford it, and a disproportionate number of those people are young, right? So find me a 24-year-old who doesn't have a disastrous story to tell about an overdraft charge that they had that they found was ludicrous. And well, I'll be surprised because all of my clients talk about it. And so I actually, as a new entrant, we actually are very proud of the fact that we don't have any ties to the existing brands. We haven't taken them for investment. We find that our client base reacts to that extremely positively because they want to believe that something different can happen, that a different type of company, a different type of business model, more transparency on the client side from the get-go. But I think looking back, it's going to be no surprise that a number of important new financial service brands were built in this decade where the millennials come.
Adam, is that entirely true? Who's your custodian relationship with?
We use Apex, which is an institutional, right? It doesn't have a customer facing.
So you're your own custodian then?
No, I said Apex.
You use Apex as the back end, yeah. So those kind of partnerships, I think, are what we'll see continue to proliferate. So when you look at Stripe's relationship with Wells Fargo, when you look at, Future Advisor has a relationship with Fidelity as a custodian relationship, and many, many others. You see a lot about these banks as a platform, right? And there's a lot of important things that the banking institution is providing, whether it be in the asset base or the regulatory base or whatever sort of underpinning that they have built up in the regulatory side or the asset side, which is really important for these startups to partner with. So the startups might own sort of the relationship in the front end with the consumer, but I think there's a very big role for these financial institutions to play going forward in a more partnership.
So I think it's worth diving into that. But I think in terms of the consolidation aspect, I think the biggest challenge is that if you look at, say, the marketplace lending universe right now, it's not accretive for a traditional financial player to buy one of those players because we're priced and valued at a much more efficient capital usage. So we're not a capital intensive business. Right. We're valued on multiples that reflect that. If a bank acquired us, they're a capital intensive business and you lose that value. And I think that's one of the big barriers. I think within the context of how we interact with the banking universe, the first time we had a bank come and buy loans from us, it to me was a very interesting paradox. It's like, why are you buying these loans? Why aren't you originating them yourself? And the reality is there is a reputational issue, there's a trust issue, there's a credit segmentation capability, what traditionally made banks unassailable, which was FDIC insurance, now invokes huge amounts of liability that they have to manage, and it prohibits their ability to segment credit effectively. So there's reasons why these have opened up. But I think it's the 800-pound gorilla in the room, which is, does this coexist? So are we just going to end up being the front-end origination arm of a bank, which ends up being the buying aspect on the back end? Or are we actually going to go and try to usurp what right now makes the banks unique, which is the deposit function? And I think that's what you're going to see in the marketplace lending universe. You're going to see players go after that deposit side of the business, and that's where I think the gloves come off in terms of how we coexist.
But then you're seeing relationships with Citi and Lending Club, right? That just that were just recently announced as well.
And I think it's a viable path, and I'm not saying that there isn't an opportunity set to be that origination arm. I think that if you're really thinking about changing the landscape, you're thinking about changing both sides of the balance sheet, not just the lending side. You're thinking about the deposit or the asset side as well. And I think you're going to see marketplace lenders move into that, and it will beg the question.
Do you think, though, because then you have reserve requirements on top of your valuation multiple?
Well, no, but I don't think you become a bank.
So
I don't think you ever become a bank. So, and I think that's the whole key is there are ways to attack the left side of the balance sheet to get sticky retail capital in where you're not an FDIC insured institution. And I think that's the key. It's difficult. So right now, for example, we went to the Federal Reserve and lobbied for a national lending license. So unlike most marketplace lenders, we have our own lending licenses on a state-by-state basis. And it would be a lot easier if we had one national license. And what we were told was they'd be happy to give us a license if we're willing to take FDIC insured deposits. And to me, that was ridiculous. Why do I have to take FDIC insured deposits if I don't need them or want them? By doing so, massively disrupt my business in a bad way. These are things that we have to navigate and work around. But folks like SoFi and Lending Club and Prosper are figuring out ways to do that.
You bring up an interesting point about regulators, and we are fortunate enough to
the
have one on
CFPB
this
is my
panel.
favorite regulator, by the way.
I'm the total regulator
awesome
on this panel.
But it does bring up a really interesting topic of discussion, I think, because you look at industries right now that are being massively disrupted, transportation with Uber, let's say Airbnb with hospitality and hotels, and they're both having like major issues with regulators. So what's your perspective on how that's going to play out, in the fintech world for all of you?
So I think there's a common perception that we're not regulated, which is wrong. I mean, obviously, we have to comply with, from a lending standpoint, things like ECOA, Ruspatilla, FICRA. I can give you a whole bunch of acronyms that make my life miserable every day. On the security side, we have to comply with the SEC and FINRA. But then from a regulatory standpoint, the CFPB is our primary regulator. SoFi is a little bit unique in that we're also regulated by every state that we have licenses in. We've adopted a very proactive approach, which is talk first, execute second, and that's thus far worked. I think we don't have the burden of FDIC insurance and the CRA restrictions and other limitations that come with that, and that gives us a lot of flexibility in the marketplace, but we are heavily regulated already.
Well, and I think playing nicely with the regulators, I think if you look at Lending Club and Prosper, how Prosper started out, Prosper didn't play nicely with the regulators. They paid a really heavy price for that. And when Lending Club came around, I mean, Renaud, the CEO there, was a securities lawyer in his last life. And he went proactively to the regulatory body. And to your point, ask first or have the conversation first and then act is very much the doctrine that they've set forth, and it's enabled them to be pretty successful. And regulation isn't always hurtful. I mean, regulation is there for a purpose, right? And so working proactively with the regulators, in my perspective as an investor, is really an important aspect to any of these businesses in terms of making an investment decision.
Yeah, I think I do think there's different subsegments in financial services, and so on our world, on the investment side, it's less about issues of lending and deposits, et cetera, and more of the world of the SEC and FINRA, et cetera. But we, like I said before, we see ourselves in the trust business. It's been very beneficial for us, I think, for clients to come in and see that we're SEC registered investment advisors, that we're FINRA regulated, that we have a third-party custodian. The difference is that I think from some of the companies you mentioned, is we've tried to be very forward-looking. There's been a lot of activity, frankly, in the industry in the last 5 years fighting a lot of regulations, both new and old in some cases. We built Wealthfront from the ground up for the current regulatory environment, right? So in our universe, fiduciary standard isn't a debate. That's how we've always operated, right? There isn't a single trade on a single client account that hasn't been automatically validated and monitored against the investment strategy that the client signed up for, right? And so building systems from the ground up, whether it's the back office, mid office, front office, in a pro-regulatory form, has actually been a big advantage for us. We are coming up more and more, I think, as an example that some of these services aren't impossible, right? That it isn't impossible to provide fiduciary service to small accounts with high quality and low cost. And we're happy to be that example that technology can mean that individual investors can get better service at lower cost in the future.
So from a regulator's perspective, the way I personally look at the role of regulation is, first of all, it has to ensure the level playing field for everybody. So the CFPB is in charge of supervising both banks and non-banks that provide financial services. So whether you're a bank or non-bank, whether you take deposit or not take deposit, as long as you provide a financial service, you are equal in front of our rule. The second thing we have to ensure is to make sure products are safe for consumers to use. So, and I think we are really witnessing some sort of a revolution in the fintech space. And the question for us is, do we want to be left on the sideline, or do we want to be part of it? If we can be part of it, then what kind of role we can play? So we had a lot of internal debate and discussions, and finally we decided to launch something called the Project Catalyst, which is an initiative that I'm heading now. And the purpose of this initiative is to promote consumer-friendly innovation. And we are relatively young, and the bureau is very young, and this initiative is even younger. We have found a few, sort of tools to help to achieve this goal. One is definitely engagement. I think the risk for any regulator in this space is if you don't engage, you're gonna lose out. You're gonna be outdated. So we have a very popular program called Office Hours, where we bring the bureau's subject matter experts to Silicon Valley, to New York City, where all the innovators reside, and we ask people to come in. Startups, entrepreneurs come in to have one-on-one conversations with bureau's subject matter experts. It's closed door, off the record. You can you can share any information you feel comfortable sharing with us, and you can also ask us any questions, and we will do our best to answer those questions. Obviously we cannot provide legal guidance. We cannot be your compliance officer. We cannot be your attorneys. But at least the role we're trying to play is to be the sounding board. The second thing we're trying to do is actually we do have a policy in place already. It's called the Disclosure Waiver Authority. So Dodd-Frank gave the Bureau the statutory authority to grant statutory waivers for companies that want to test alternative disclosures that otherwise will not fall under existing federal disclosure requirements that the Bureau has jurisdiction over. So this is a very protective and powerful waiver, and has attracted a lot of companies that want to test new disclosures that are deviating from the existing, paper-based rules which were written back in the 70s and 80s when there was no internet and when there was no mobile phones. And the third policy we are still, in the process of finalizing is called the No Action Letter. So I think with the technology, a lot of the fintech companies are entering what I call uncharted water, or pushing the regulatory envelope. So there are a lot of things that people were never ever able to experiment in the past, but now they have become reality. So what sort of the things that the Bureau can do to remove the regulatory uncertainty for these companies that are trying their best to provide consumer-friendly products, but also are uncertain about what sort of enforcement actions or regulatory actions may come from a regulator such as the CFPB?
It sounds like in a lot of these examples we've given, there's been a sort of symbiotic relationship with regulators, and like you said, people work with regulators from the beginning. But when we think about the title of this panel, modern money, and like the futuristic vision, let's say cryptocurrencies and things like that, I mean, you have to think there's going to be more tension there. I mean, is that something that at least, do some of you think about that? Rebecca, I don't know, because you invest in this area.
Right,
so.
right. No, absolutely. I think cryptocurrency, they're really going to have to figure out how they regulate that whole area, right? And I think it's an unknown right now. I mean, some of the initial suggested regulations suggested that software companies like SAP may fall under these regulations, and that was pretty much dismissed fairly quickly. And I think what's going to happen is it's more under the Patriot Act, the KYC, the AML, all of those issues are going to have to really be sorted out. And I haven't seen really clear guidance as of yet in terms of where that's going to go or where that's going to end up. But you have competing forces. You've got people wanting to help people in countries like Somalia have access to money that's coming in from their families, right? And then you have governments trying to prevent money from getting in the hands of bad actors for terrorist issues. So you have some really really compelling human interest issues here that I think we're going to have to work our way through.
Yeah, I was just going to add the point about globalisation and the we talk a lot about regulatory arbitrage, but you can see that happening at national levels as well, as countries create opportunities for innovation in their tech hubs, etc., to generate more interest and to try and attract capital. They have different regulatory frameworks, etc. And I think, putting aside companies, I think at a country level, at a national level, regulation is not consistent, and it's at times opportunistic. And I think that isn't particularly helpful, particularly when you're trying to deal at an international level and you have consistent principles about consumers and safety and security of the system. I think what I would like to see is greater coordination globally. This point about consistency, I think, is absolutely critical across all the activities, not just the entities. That said, I think this test and learn thing is absolutely fundamental, because we as a bank, and most of us up here and out, in the audience, you can't actually predict where this is going to go or how it's going to look. And we're doing a lot of test and learn, and the whole concept of try things, see how they work. And yet the burden on a regulator is, okay, look forward for the next 5, 10 years, work out the unintended consequences, etc. And we need to be more realistic, about that. But I do think that the other concern I have is just the layering of regulation from different bodies and needing to work with several of them.
Well, and you're seeing it, some of the other panels have talked about how a lot of banking relationships, the U.S. banks have just severed altogether. You're probably the most familiar with this, with sort of at-risk countries. And as that continues to roll forward, what the attitude has become is not risk management, but just elimination of risk. Because by cutting off a lot of those sort of at-risk or more volatile countries, the profitability of the banks has actually improved. But at the same time, there's a real human impact to that, as those banking ties and those banking relationships have been completely
severed. And a visibility of flows and all of those sorts of aspects. So international remittances is a great example.
Exactly.
SME lending, and there's a number of areas where banks have just decided to opt out of servicing that.
And that's, you're saying, even nationally as well, right? So there's an opportunity for...
So infrastructure lending and the capital requirements of that at a corporate level means that it's less attractive for banks that traditionally did a lot of project financing, and now you're starting to look for different ways of financing it, which I think is a good thing. I think there needs to be more capital and we need growth in the industry, and it shouldn't all fall on the banks, and there needs to be more competition from outside the banks. But some of the regulation has an unintended consequence.
Adam, you brought up a point earlier that I want to go a little bit deeper on, which is, the millennial, there's this millennial generation, but then there's also a baby boomer generation. And I'm curious, how, Mike, you sort of view that, because are you seeing more, do you see that segmentation, and do you see your product gearing towards that, millennial generation and the baby boomers?
So I think it's interesting, because we started our business in student loan refinancing, which seems like a very obvious product to have, but the banks had never done it. And I think it's testament to the fact that they just aren't really focused on this customer demographic. I always tell this story, well, I don't always tell it because it happened about a month ago, so I've told it since a month. But I was in New York and I was talking to a major bank about buying mortgages from us. And I was explaining why we were doing high loan to value loans, because if you were 35 in San Francisco, for example, you want to buy a home, the bank would want you to put 30% down. You're buying $1 million home, which unfortunately in San Francisco is about the size of the square.
Can you buy one for $1 million?
Well, the size of the square. It's a very small unit,
My
efficiency unit. and you don't have $300,000. So you're great credit, you got great cash flow, you have a phenomenal opportunity ahead of yourself, but you don't have the $300,000. So I was explaining, we're doing higher LTV loans. We'll go up to 90%, we put 10% down. Putting $100,000 down on $1 million is very different than putting $10,000 on $100,000 in terms of borrower walkaway risk and so forth. And it was a typical meeting. I have a 55-year-old managing director and a 35-year-old vice president. The managing director just continues to look at me more and more incredulous as I'm going through the story. And at the end, he's like, "This is the stupidest idea ever. It's a dumb product. I don't know anyone would ever take it. I would never buy a loan like this. This is ridiculous. I'm sorry I wasted half an hour of my life with you." And then on the way out to the elevator bank, the 35-year-old grabs me and is like, "I need the loan." And it's just representative of the fact that I think there's a huge opportunity set out there, and the banking industry isn't geared to deliver product into it, and that's where people like ourselves come in.
We bought our first place in San Francisco with 5% down, right? This was in '98. And just, I mean, and literally had to scrap together everything we had to do the 5% down, but we doubled the money on that first place, which then rolled forward, right? Just because of what was happening in San Francisco.
And there's no bank today that's going to do a 95% LTV without mortgage insurance, and that's
it's probably the wrong time to be asking banks to go into that game again.
Yeah.
Yes.
Well, no, but this experience, there's some commonality to it, because I've had the opportunity to meet with many executives running traditional wealth management practices across the spectrum, different business models, et cetera. And that same dynamic happens in the meetings, right? Like the economic structure is so radically different, right? You know, in our space, which is very different than lending, most of the money in wealth management and advisory is spent on retail locations, service, and sales, right? And it drives the economics, right? It's very expensive to attract high net worth clients, and it's very expensive to keep them happy. And it doesn't scale particularly well because a traditional wealth manager can only take so many clients. And if you're a high touch service, which you have to be at the high end, the ratios are even harder to maintain. And I hear that those guys get paid pretty well as well. So, and so you run through this and you have this meeting, you tend to have older executives, very established. They know their numbers backwards and forwards. And everything you're telling them about your business model, it just defies imagination, right? Like their world is not filled. It's not just the retail location, the sales and service, this idea that you could profitably offer a service as something as low as 25 basis points. It's below the cost structure. And the idea that your average account, like our average client has $90,000, which is actually fairly high for an online service, you know, you have this experience. And then it's always the younger associate who then all of a sudden says, well, I have a Wealthfront account, right? Like I've been using the service. And we've had this experience time and time again. We've even had executives come back to us from traditional banks and brokerages and say, well, you know, it's funny, I asked my daughters if they had heard of Wealthfront, and I found out that all their friends use Wealthfront. They love this idea, but there's this, I really do think there's almost a psychological gap, this unwillingness to actually entertain the idea that young people may have a very different idea of the features they're looking for, how they establish trust, and what services, what features they prioritize, which is why I think you see all this innovation. Technology always unbundles services, right? Like in the beginning, there's a lot of debate about what's possible. So you see dozens and dozens of single point products and features and services, massive experimentation. And then once the innovation edge comes off, you see this aggregation of those services together. And I think we saw a lot of aggregation. There was a lot in the last 20 years, which was about selling more and more features and services to the same client base. And I think that trend is just reversed in the last 5 years. We're just seeing a massive unbundling, a lot of experimentation. And for the next 10 to 15 years, in my view, you're going to see a lot of this trend of experimentation of what really sits in, what sinks in, what works with this new generation. And then we'll see the predictable trend, which happened with the baby boom generation as well, of larger and larger aggregations of these services as that generation goes from their 20s and 30s to their 30s and 40s and 40s and 50s.
Yeah, I mean, we've invested in a company that does these sorts of services. Clearly, we also see these trends, but I also think that you have to take different segments and depending on who you're targeting. So in Mexico, we've got 2.5 million people on a product which will make about $2 a year in total revenue, and breaks even at about 1.5 million people on that product, and it's a product that's appropriate for that segment, etc., and appropriate for our position in that market. Whereas in the US, depending on what segment you're going after and how you're positioning yourself, I think some banks are engaging in these sorts of technologies and are connecting with companies, and some other banks are, consciously choosing to target different segments. But I completely agree that, and that's why I think the partnership thing is so critical. We do not have the capacity, the capital, or the capability to go and do all of this stuff, and nor should we try. But we need to find partners that can do it, and we are investing in those sorts of companies.
Great. Do you think that's is that really the future? Because it does feel like maybe, in that way, you could potentially be locking yourself out from, some businesses that are doing very well, and they could be part of you. I mean, if you think of the way that, corporations are acquiring technology companies these days, it's happening at a pretty rapid pace. And I'm just curious if, why you think partnership versus acquisition is the right way to do that.
Well, I think acquisition on capabilities is more likely, where you want to try and get data scientists, UI, UX capabilities, design skills, etc. And you see some of those
talent.
Yeah, you see some of those acquisitions. But when it comes to fully fledged companies with P&L and with real capability, to bring them in and then say, okay, here's our world, stretch across that, and all the different challenges that go along with that. Even the language becomes one of absorption, as opposed to one of partnership, where you can learn a hell of a lot by working with those companies. And in fact, one of the big distributors that we're working with, but an innovative one, our teams work out there on site on the West Coast. We didn't bring that team in to work with us. We just didn't want that sort of a cultural influx into our organisation. We want to take our people out of the environment they're in.
It is really hard to make acquisitions work. I mean, if you ask most engineers that work at Future Advisor or a lending club or the guys at Check and say, hey, do you want to go work with Wells Fargo? I mean, the answer, or a bigger organization. I mean, the answer is no, right? That's not why we're in Silicon Valley. That's not why we came here. That's not why we do what we do. And most marketing people are the same in that realm, and most people just at startups in general. So trying to merge those two cultures, there are very, very few successful acquisitions, even when Apple has bought these companies. If you look at the number of people who are still around, after that vesting or after the golden handcuffs come off, it's minuscule. And so I think for these bigger companies to actually get the benefit of these new services and new products that are coming out, they really do. I think partnership is the right answer here. Both parties have something really valuable to bring to the table, and if they find the right partnership structure, I think that's probably the most symbiotic way to work together.
Yeah, I think one of the challenges, especially with the financial services firms, is a lot of times they want to own that customer relationship. And so it's a fundamental proposition of what your business model is. If your business model is transactional, where you're trying to make money on a particular transaction for a particular product that a bank isn't active in, then there's a lot of synergy in the partnerships. If your business model is LTV, and you want to own that relationship, and you see your ability to sell up and across into that relationship, it's much harder to build strategy and synergy with existing financial services firms. We've had multiple companies that have come to us willing to seed new product out, but they want to take the customer, and we've always declined. And so we have banking relationships, but they're servicing retained relationships where it's purely capital.
Well, and sometimes there's a time and place to take that customer, right? I mean, we're not in Stripe, but what I've been told is that, with the Wells Fargo Stripe relationship, when a customer gets of enough size, then oftentimes Wells will seek a direct relationship with that customer, right, and pull them off the Stripe platform altogether. But up until that point, there's a very valuable role that Stripe is filling to enable, to basically service a customer that Wells would not have been able to do otherwise. So I think those kinds of things will happen as well.
We're going to take some time to take some questions from the audience, but before we do that, I want to go back to the origin of what we were talking about. How do you think your technologies and the technologies you're investing in, and even some of the ones we've been talking about that you're partnering with, are going to really fundamentally change the way we change human culture? You know, change like the way we think about money and paying and saving and all of that. Yeah, go for it.
So I think, you know, in venture, you're really lucky to, or being an entrepreneur as well, to do things that you think will positively impact the world and culture. And it may be a little too idealistic, but when we do investments, I always think of that, because there's a lot of ways where you can spend your time and money. So it's better to do something that you really think has a positive impact. So with Lending Club, I mean, 80% of their loans are actually going to people who are paying off high interest rate credit cards on a fixed rate product, which I think there's probably nothing more responsible than that. And I really love that aspect of the company. With Check, they were helping people basically manage their money. And so taking that burden off of somebody to sort of tell them what they owed, when they owed it, and to help them avoid late payment fees, which are a huge burden to especially lower income people, who are paying an extraordinary amount of overdraft fees. And then with Future Advisor, actually providing the same service of wealth management to people who typically didn't have 10 million plus to invest, right? People that have a few $100,000 to $1 million of investable assets, providing a very real service for them, helping them manage their money in a better way for a much lower fee. So we think that all of these investments have really, or all these companies really are doing positive things for people in general.
What about like you with like eliminating kind of a person in that way?
Well, I've actually checked, and all the employees of Wealthfront are actually people. But no, actually, I think it's a reconfiguration. It's a reimagination. We have a brilliant investment research team of PhDs led by folks like Burt Malkiel, Charlie Ellis, folks who really define their careers on the side of the individual investor. We just happen to believe that we're only going to see incremental change from the industry as long as it's trapped by the existing economics, right? And software happens to be a force where it can fundamentally change the economics. We can offer a service with dramatically lower minimums, lower fees, and higher quality, in our opinion, because of the economics of software. And so we've built the business from the get-go asking the question of how do you marry world-class financial talent with the best engineers and designers that Silicon Valley has to offer, right? The folks who build the Googles and Facebooks and those type of firms. And so, I think you'd find that a lot of the employees at Wealthfront are very mission-driven. A lot of young people. Our average client is in their late 20s and early 30s. Our average employees in their late 20s, early 30s. And so they're very much reimagining what this service could be. And I think there's a lot of passion around money in general. I think that this generation is growing up. And they're not happy with the status quo. And so one of the things that we're excited about is that as we get to scale, right? Wealthfront at $100 million, which is where it was when I joined a couple of years ago, well, that's kind of an interesting small registered investment advisor. At $2.3 billion, we're one of the largest in the country at this point, top 100, just 3 short years. And all of a sudden, our opinion about things matters. How we allocate our clients' capital matters, right? We're now allocating billions. Using that weight, kind of the way that Vanguard has done historically, to bring lower costs and better service to individual investors is a big part of our mission. And so for us, there's this kind of flywheel. The more Wealthfront grows, the more weight we have to give better value at lower cost to our clients. And so we think that that's a force that can help change the industry. And frankly, we've seen a lot of result from that already. We now see incumbents, large firms like Charles Schwab, spending a huge amount of money to offer an automated service to their customers. And we know for a fact they wouldn't be doing that if Wealthfront didn't exist, right? So we believe that everyone deserves sophisticated financial advice, and we think that a commercial entry of a product that does that forces the whole industry to react.
And I just want to quote Paul Volcker, who in 2009 famously said, "The only socially beneficial innovation of the past 25 years is the ATM." And I think I respectfully disagree with Paul Volcker on this, and I think technology has done wonders. And I think what we're seeing in the fintech space is technology has enabled financial service providers, banks or non-banks, and in this case probably mostly the latter, to offer products that can promise lower transaction fees, lower borrowing costs for consumers, bring the underserved or unbanked, debanked, underbanked consumers into the modern electronic payment system, to expand access to credit to people who otherwise cannot get credit, and to help simplify people's financial lives. But with all the benefits as a regulator, things that are, technology is a double-edged sword. It comes with benefits, but also comes with lots of risks. And these risks are keeping us awake at night.
Volker's a little curmudgeonly, but I think to build on something earlier, and I'll go very quickly because I know we have to get into Q&A. If you think about these two water bottles as someone with money and someone who needs money, the way that the process works today is, that one was mine.
I know, I have more in it. So
is the person with money allocates money to an advisor who gives money to a manager who buys securities from a dealer who gets those securities from a bank who lends money, right? And that is a very inefficient, fee-laden ecosystem. And it doesn't benefit either the person with money or the person who needs money. And so the point of disruption here is way beyond the bank as the origination point. It's the whole capital ecosystem. And that's really what we should all be thinking about in terms of what the big opportunity is. If you want to build a $100 billion business, not a $5 billion business, you need to be thinking about disrupting that whole ecosystem. And that's where the opportunity sits.
Okay, last comment. I think we also just need to think about emerging markets. There's 2 billion people without bank accounts. The cost of cash is highest for those that are poorest, and the opportunity to change lives and change relationships to cash and capital, etc., I think is greatest in those markets. I think the opportunities here are to make greater discovery and access. But the true differentiator, I think, is about financial inclusion and participation in all of the opportunities that are there. And that, that has some aspects of what we're talking about, but I think even just basic access in those countries will be transformational.
Absolutely.
I believe there's someone with a mic in case anyone has any questions. Looks like here.
Sorry.
I'm grabbing your rhythm.
Hi, I'm really interested in why none of you guys, well, apart from Citibank, that is, want to be a bank, and what you think and how you think that you can get scale without actually being a bank. I'm a director of a bank. We're just getting set up in the UK, and we're digital only. We're hopefully getting our license next month, but we just immediately thought we want to be a bank, a different kind of bank, but a bank. So I'd quite like some more feedback on why that doesn't work for you guys.
When was the last new banking charter issued? Do you remember?
I don't know what the last one is, but as if memory serves, that I remember 2011,
Yeah.
Green Dot got a charter. Yeah.
They got a charter. And then I think all the recent ones have been with some kind of a religious affiliation of some sort. So you could try. For one, there's many reasons why you don't want to get one, and we can't answer that question for you. But let's say you wanted to get one, we would never invest in that business because the likelihood is so low that actually would happen.
Yeah, I remember
We're raising lots of money, so that's
No, in the UK it's very different. We actually have talked to companies who literally are going to the UK first to get a banking charter and then coming into the US post that, because it's easier to get a banking charter in the US doing it that way, because there's sort of a reciprocity kind of thing. But there's also the reserve requirements, the regulation, the OCC regulations, the just all of the FDIC insurance requirements. There's a lot of those things that are highly valuable that are very hard for a young company to handle.
Yeah, in 2009, I went to buy a bank, And I sat down with the FDIC, and they said, we don't sell banks to your kind of people. And I was like, taxpayers? I don't know what
anymore. They did, because NextCard did that. NextCard bought a.
Well, I was a hedge fund manager, and they didn't want to sell the bank to the hedge fund manager. So in 2010, I came up with a plan about community reinvestment, and I went to buy another bank, and I got shot down again. And I said, you know what? I don't want a bank anyway. I'm going to make a non-bank. So, but the reality is, it's hard to get the charter. There used to be an OTS charter, which was effectively a non-depository national lender, which was a very effective charter to have. The Fed took that over when they took the OTS and stopped issuing that charter.
The OCC, actually.
OCC, you're right, sorry, the OCC. And so it's difficult to do, but at the end of the day, once you become a bank, you are run by the FDIC, by the Fed, by the OCC. You trade at a multiple to book, and you're very capital heavy and capital inefficient. And so you can go that route in the US, but you're not going to be building a big business off of it.
Well, maybe we'll be coming back to the US later then.
Oh.
Thanks. This is a question for Adam. Adam, you mentioned in one of your answers Vanguard, and you guys actually have a great post on your website called "How Does the Wealthfront Service Compare to a Target Date Fund?" And my question's pretty simple. It's what value do you feel you need to add above and beyond a Vanguard Target Date Fund to kind of justify your existence and your value proposition to clients? Is that 1 basis point annualized over a decade? Is that 5? How do you think about the hurdle rate for your firm? Thank you.
Yeah, it's well, I apologize. It sounds like the post wasn't sufficient to answer that question. I'll have to go back and maybe do a new one. It's actually very simple. We're big fans of Vanguard. Vanguard, I think most of the people in this room probably know, is one of the big innovations that I feel came out of the 70s to better investing for individuals. And they did it through a very interesting, almost business model innovation, where the funds are actually owned by the fund owner. So any excess revenue effectively gets redirected into lowering the expense rate. So it's not a nonprofit, but it's almost structured that way. And it turns out if your goal is long-term managed, low-cost investments, particularly index products, that's a very, very efficient way to do it, which is why, we don't have any fund products ourselves. We're a registered investment advisor, but if you looked, about 2/3 of the funds that we recommend are Vanguard funds. They're not the best in every category, but in quite a few, the combination of low cost, tracking error, et cetera. Now, those are the individual asset classes. The target date fund, I think, represents the first generation of innovation to try and help the individual investor, which is to make it a financial product, right? But it's a one-size-fits-all product, right? A target date fund doesn't know whether it's in a retirement account that's tax-deferred or in a taxable account. A target date fund thinks that every 25-year-old is the same, whereas one 25-year-old might be making $50,000 a year and have saved $5,000. Another might be making $110,000 a year and have saved $50,000. And the truth is, their risk tolerance is not going to be boiled down to their age. So I think the advantage you see in a service like Wealthfront is something that previously was only available to the wealthy, those larger accounts, which is a degree of personalization and optimization, right? So at Wealthfront, it actually is a brokerage account, right? You get a different asset allocation for a taxable account where you might want to prefer against short-term gains or dividends or income, versus a retirement account where actually you might optimize the asset allocation on before tax return. So things like asset allocation, we do strategies like tax loss harvesting. Even our new direct indexing platform, we actually own the individual stocks in the index rather than owning an index fund altogether. So that trend of unbundling, every time we peel that onion, we discover that through personalization, it's your account, your assets, your risk tolerance, your tax lots, we can make optimizations that no single bundled financial product could ever do, because it has to be, by definition, one size fits all. So we publish what you would describe as the hurdle rates on all those different strategies, but they're fairly significant. I mean that our fee is very low. We're free under $10,000. But the benefits of things like even intelligent dividend reinvestment can be 10 or 11 basis points, which is phenomenal compared to what you get in a standard target date fund for 17 or 18 basis points of expense.
I think we have time for maybe 1 or 2 more questions. Anyone? Oh, there you go.
Sorry. What do you think about the, will you get into alternative investing within Wealthfront, into hedge funds or a lending club and buying loans and using your data to have visibility into performance and risk as well as tax optimization?
Yeah, well, since I've been at Wealthfront the last 2.5 years, we've redone the asset allocation a couple times. I do think that as a firm, we take our responsibility pretty seriously, right? Wealthfront isn't really selling the idea of investing or a brokerage account. We're actually full fiduciaries. We take that responsibility pretty seriously. And so we're always looking for ways that we can improve the risk reward, right? The risk adjusted after tax net of fee return. To date, we found a lot of optimization just on the side of expenses and in the terms of taxes. And there is a reality of the fact that the efficient frontier of asset classes, there's diminishing returns. 3 asset classes to 7 to now 11 at Wealthfront. It doesn't go forever. But we're always looking. We think that one of the exciting things about Wealthfront, like I said earlier, is that as we get to billions of dollars and tens of billions of dollars, we actually have the economic weight to maybe provide access to asset classes or to investments that individuals haven't been able to get access to before. Most likely, though, we'll use that weight to just get better and better deals on vehicles that are better performing in the mainstream asset classes that we do today, right? So whether that's U.S. equities, emerging market debt, or anything in between, we're always looking for ways to lower costs and increase value.
Okay.
Can we do a lightning round where you just ask everybody what you think will be the next big thing in finance?
Sure.
In the next, say, 3 to 5 years. Next big thing in finance.
We'll put you on the spot, Greg.
Oh, next big thing in finance. I think the more intelligent use of data.
Someone's going to build a DDA equivalent account into the ACH gateway with private insurance to take on FDIC-insured deposits.
Well, I think back to a comment you made earlier, I think solving this remittance issue for the billions of people who just don't have access to cash, I think somebody will figure that out.
I think excluding Wealthfront for a second, I actually think that the next 5 years is going to be about this trend in automation, this idea of not just telling people what to do or giving them information, but automating the right behaviors across everything, whether it's budgeting, saving, investing. I think automation, using artificial intelligence to help people do what they're supposed to be doing better is going to be a huge trend.
I think about 2 things. One is big data. The second thing is real-time payment.
That's ambitious. The Fed's faster payment initiative, I know, is something that you're involved with, but I don't know if the corresponding process is going to be faster. Hopefully the system will be. But the only other thing I would say is that cyber is kind of the long tail thing that, we just don't know how that may play out and the risks associated with it. So that's the other thing that I think over the next 5 years will be a critical theme.
What's that? I'm sorry.
Cyber.
Cyber.
Cybersecurity.
Can I just ask a question? It's interesting, nobody on this panel mentioned Bitcoin or digital currency.
That's what I was referring to.
Oh.
Yeah, in terms of the remittance, and
Okay.
I think the answer to that lies in digital currency.
Okay.
Sorry, wasn't clear.
Great. Well, thank you so much, all of you, for joining us today. Thanks for the discussion.
Thank you.
Thank you, guys.